Mike Green, I'm here in Sacramento for Real Vision. I'm really excited to sit down with John Moorlach. John, you're the California State Senator representing the 37th District of California, which Huntington Beach, the Orange County, Costa Mesa area. Wanted to briefly dig back into your background, though, because you didn't start in public service. You actually started as a certified financial planner, right? A CPA, actually, I'm sorry.
Yeah, certified public accountant. That was an accounting major.
Yep.
And was with the firm for a number of years, actually 10 years as a partner, and also acquired my certified financial planner license, and didn't sell product, but just to help my clients with their other professionals to make sure that they were focused on an estate plan.
And then you were recruited to run for state treasurer, is that correct?
That's correct. I had moved into a larger home in Costa Mesa, and my neighbors across the street were involved in the local Republican club, and I still had my Reagan Bush bumper sticker on the back of the car. And so I kind of got recruited, and over time I was involved with their club, and they said, run for Central Committee, and I did and got elected. And then chairman of the Central Committee one night said, why don't you run for treasurer? And I said, no, I'm treasurer of enough boards. And he said, no, we're talking Robert L. Bob Citron, Orange County Treasurer, tax collector. And I didn't react well to that either, so I had to kind of take some time. Found myself backpacking out of Tuolumne Meadows, Young Lakes, and on the way home on the 395, a good friend of mine who's now here in Sacramento as well, he's the CEO of the fairgrounds, the state fair. He said, John, you've been complaining about this idea. Why don't you just look at it and make a decision? You'd be home every night if you got elected, and then you could work with the supervisors and help them out. You'd have the king's ear. And so I said, okay, Rick, I'll do some research. And then when I saw the portfolio that was being managed, I was able to get a copy. I was rather astounded that there was so much leverage being utilized. I would never put a widow or an orphan, in a portfolio like this. Why are all the taxpayers of Orange County involved? And so that sort of triggered me to run.
And so you and I know this situation very well, right? In 1994, Bob Citron, who was the treasurer for the county of Orange County, had invested his assets, the cash that he had on hand, effectively into an interest rate swap that offered a slightly higher return than money markets at that time. We had experienced a significant decline in interest rates from roughly 9% in 1990 to about 4.5%, if I remember correctly, maybe 5% in 1994. And Citron effectively placed a very large levered bet that interest rates were not going to move higher in order to get a little bit extra yield on the cash. Is that correct?
It was an arbitrage play. He would borrow at the short end of the yield curve, pay maybe 3%, buy at the 4-year level, which was paying about 5%. So you make the 200 basis point spread. And that's all great if the short end of the yield curve cooperates. And he anticipated that it would even decline. But in fact, Alan Greenspan said, I think inflation is starting to raise its head. We ought to do something about that. We ought to raise rates. And so during the year he did. And it coincided with my campaign saying, look, he's raising rates. You're losing value. You took $7 billion in assets based on what the county had and what 187 other municipalities decided to chip in, and you levered it up to 21 billion. It's just amazing. And if those short end rates go up, then you're in trouble. He had collateral calls, but I only had beat reporters following the whole thing. So, like I said, it was sort of like if I said in a conversation we had earlier, that it was like The Big Short. You're trying to explain to everybody what's going to happen, what could, it could be a massive implosion, and they're all looking at you like, oh, you're just a gadfly, you're just a kid.
Well, you mentioned The Big Short, and this really was. This was kind of the original Big Short. We actually created a situation in which derivatives blew up a significant financial entity and caused widespread distress across Wall Street. It wasn't just that Greenspan had raised interest rates. We actually saw the financial consequences of Orange County being unable to meet its financial obligations, right?
Right, and they were inverse floaters, a derivative, kind of unique, and when rates would go down, the yields would go up, inverse, and plus the leverage, and then once Greenspan decided to start, not being aware of what Citron was doing, but just doing what he had to do for the economy, then most people in the carry trade would have disengaged. They would have started paying off the lenders and getting out, but Citron basically doubled down.
So when you brought this up, you were widely dismissed, and you were actually, in a conversation we had earlier, you mentioned that reporters would call you up and say, is there anyone that you have that is of a similar caliber to S&P, for example, to comment on in support of your side of the story? Or are you just being political in this analysis?
Yeah, it was tough. I mean, I was like staying awake at night looking at the ceiling saying, okay, God, what kind of mess is this, where no one can understand how this works, and why don't they do the heavy lifting? Why doesn't a reporter figure it out, or at least hire someone, to figure it out? But Standard & Poor's said, the leverage didn't cause them any concern. Moody's was in the same place, and it was a real awkward kind of deal. So when everything went and hit Silly Hill, right, everybody's going, oh, is that what he was talking about? And it's like,
Now, you ultimately lost that election.
Right, about
before it blew up.
We had 40%, a little under 40% of the vote. So
Yeah.
I didn't do too bad for someone who came out of nowhere against a long-term incumbent.
And then you ultimately transferred into the public sector following this. And so you've spent the better part of 25 years here now representing the state of California in one form or another. That's fair. You have done a couple of things I think that are pretty unique. I mean, one, we had a conversation earlier. You used to host a podcast. Hopefully you're going to come back and do that again. And you run a blog that is very transparent in terms of what you're working on, what's being done on the Hill, et cetera. How engaged do you think your constituents are? How aware do you think the average politician or the average citizen is with local politics as compared to national politics?
Well, we're certainly seeing newspaper readership decline, certainly seeing a lot more being done on iPhones and iPads and terminals, computer terminals to see laptops, what your news is. We're not getting the kind of information that we used to get 25 years ago. In fact, newspapers were even wider and bigger and heavier. We used to have a business section once upon a time that was multiple pages. So I would say that most of my constituents are relying on social media, and it's sort of a selective process of what you want to actually read and know about. And so it kind of focuses more on the national level than the local level.
I think that's very true, and I think that's one of the challenges that we have with social media, because you can leverage the digital information, right? You have the digital information superhighway to get something out to a much larger audience. Advertisers are obviously more interested in a wider audience. The platforms are built up for this. It doesn't seem like we have a great mechanism for sharing the information of what's going on in the local situation. You, about 5 years ago, gave a speech, or a big, very short segment, about 2.5 minutes actually, on public access television, in which you brought up the idea of accountability or responsibility. You were discussing legislation that was being introduced there was a proposed that there would be a report, right, with the conclusion of this. And you brought up a really great question, one that I don't have an answer to, and I'm not sure if it's been answered for you. How do we measure accountability in the public sector? How do we think about, we pass a law, we do something that establishes a standard that has to be followed? How do we decide if that standard has been met? Who's held responsible for it?
Great question, Mike. I even did a bill just to have the state have a CFO. Just who runs, there's no CEO.
Right.
No, it was actually a COO is what I was asking for. Cities have city managers, counties have county executive officers. State of California, has a governor who has cabinet secretaries, who has Department of Finance, and maybe it's got some balance with the legislative analyst office. But yeah, who's looking at the big picture? Why does Caltrans have 3,500 architects and engineers too many, and why aren't they being moved over to help schools start planning their next building project or something? Or why aren't they even laid off? We don't have that kind of managerial structure. We have to tell departments what to do through bills. I'm no longer an executive, I'm a legislator now. But that takes a year to tell a certain department to follow a certain format or prepare a certain report. So it's sort of an awkward way to run a state, especially one with 40 million people.
Well, the analogy is used in financial markets, right? The Federal Reserve talks about the dynamics of interest rate cuts, or monetary policy as working with long and variable lags, right? The idea being you are operating a shower handle at the very top of a building, and the water heater is 40 floors below, although it's unusual in California to see that height. And the lags are perverse. That's magnified when we start talking about governing by legislation, because by the time something needs to be done, or we're made aware that something needs to be done, it's almost inevitable that the problem is so large that it can't really be solved.
And so now you see it manifested. Poverty rates, unaffordable housing, homelessness, all these things that have just kind of been growing and growing and growing. And here we are trying to react as quickly as possible as a legislature, as best we can, with some kind of, I wouldn't say superficial, but very limited legislation to try to address certain things. And we're not getting to the right answers. We don't know how to deal with people that are severely mentally ill, that are on the streets. They're walking around. We would never let someone with Alzheimer's walk around on the streets. We haven't figured out how to free up the marketplace to build housing. We don't have housing because we have a lack of supply, but we have a lack of supply because you can't make a profit. You can't, the amount of time you need, the amount of infrastructure fees that you have to pay to your local city, at the end of the day, it doesn't pencil out. So why should someone go through all the hassle if you're going to break even on the project? So we haven't figured that out. And we have to deal with a new leader every 4 to 8 years. And so, yeah, it's an interesting paradigm.
Who, to your point, is not actually a leader in the executive sense, right? They're not, they don't have key performance indicators that they're being held to standard. Their compensation is unchanged regardless of the underlying performance. They may get voted out of office, but that compensation pales in response to everything else.
Correct.
One of the things we're really interested in is the public pensions as indicative of a broader question around American retirees, right? Because we are facing something that's relatively unprecedented. California is somewhat of a unique picture. When I was born in the state of California, there were 19 million residents. Today there's roughly 46, if I have my math correct. But we don't think that's going to grow that much anymore. The type of growth that we experienced over that time period, which I think it was born in 1500, but it's not quite that long, but we've slowed down dramatically. And suddenly the pensions, the promises that were made in an environment of extraordinary growth, are becoming due. How, as a legislator, do you think about the obligations that the state has incurred, our ability to meet those, and simultaneously the obligations to the taxpayers to not place too onerous of a burden on them as we try to resolve this crisis?
Big questions, big answers. I served on a retirement board for 12 years, one of the 200 top retirement systems in the nation, while I was the county treasurer, tax collector. There was a bill in 1999 called SB 400, which passed on the last night of session, which is usually when all the garbage kind of gets passed here in California. And it said for CHP officers, you have a formula that's 2% at 50 when you retire. So if you're making 100,000 at age 50 and you've been there 25 years, the math works out and you get 50,000 a year, one half. And they changed that formula from 3% at 50 to from 2% at 50 to 3% at 50. So all of a sudden now you're making 75,000. But they never funded for it. They made it retroactive to the date of hire. So when your pension plan was fully funded in roughly 2000 because of the .com boom, it now was 2/3 funded.
Right.
And you don't do that to a defined benefit pension plan. You do not change the formulas. You at least don't go retroactive. You may want to go prospective, but you would then make the participants pay a little more for their share. So we created this massive unfunded liability, and we're still looking at, after all these years later, but what, 70% funded? We're still at 2/3 funded. So we're relying on yields from the marketplace, which are supposed to exceed 7% per year. That's kind of tough to do, especially when you have interest rates that are so low. You're relying so much on equities. I think maybe California's been lucky the last 4 years that the stock market's gone up 50% since Donald Trump was elected president. Kind of lucky, it's kind of deferred the problem. But we're seeing cities, because CalPERS, the state's largest pension plan system, is slowly reducing the investment assumption from 7.5 to 7. They're seeing their contributions then go up because when you do the math, if you reduce your assumption, then your liability goes up. And then you therefore have to have a larger contribution for your unfunded portion. And so now cities are struggling. They're raising sales tax. School districts are struggling, even though Prop 98, which provides 40% of the state's revenues to schools, it's still not enough. So a train wreck is coming, and there are telltale signs everywhere. Cities asking to go beyond the sales tax limit and raise their sales tax even higher just to try and meet their budget. So we've got something on the horizon, and we've got a state, if I could keep going,
No,
Mike,
please.
that's got what, this year $21 billion surplus, next year $7 billion. Well, you can kind of see that trend, or maybe next following year minus 14 billion, but giving nothing really to the cities and schools to try to start undoing or unworking this massive juggernaut that's coming down the road.
Well, and the state of California also has a unique dynamic with Prop 13, right? Where the ability to raise property taxes on the value of properties is limited to a stated inflation rate, right? Or a 2% max. CPI has been running below that, so I actually believe it's less than 2% is my understanding.
If CPI is less than it is, then the number percentage is less, right?
Yeah. So when you think about that type of dynamic where the liabilities that have been guaranteed and then expanded under SB 400, as you pointed out, and that has continued, right? We've not entered into any form of restructuring where we've reduced the pensions. What you're referring to on the unfunded dynamic is those liabilities are pretty much set in stone. And then the question is, how much do we need to contribute based on our expectation of what our future earnings are on the assets that have been invested?
Correct.
Bonds are somewhat straightforward. It's difficult to argue that they'll deliver returns well in excess of existing yields. Equity has become that flex point. And so CalPERS, for example, just announced in the last year that they were actually going to increase their allocation to equities in the hopes that that would offset the decline on the bond side, right? So we're effectively speculating even more to try to meet those obligations. When you think about how this ends, right, where does it stop? Does it stop with us miraculously earning the returns that are required to keep this funded? Does it stop with us deciding that we need to restructure these obligations? Does it stop with bankruptcy?
It's probably bankruptcy, because the majority of the legislators in Sacramento are registered Democrats. And they are lucky to get into office because the public employee unions fund their campaigns. And the public employee unions will not allow for any changes in the current formulas or structure of CalPERS. They are relying on door number one, which is that investment returns will take care of the problem. And up to now, they've sort of been relying on that theory. But once the stock market levels out or declines, we'll start seeing negative returns. We'll start seeing larger requirements for contributions, and we'll be seeing recessionary effects of a down economy where the revenues are also declining. So how do you deal with declining revenues and increasing expenses? We've already seen cities that are reducing their workforces by 25%. So we're seeing a decline in law enforcement, fire safety. Now, you know, that'll be magnified. It'll be ugly. It'll be bankruptcy time. It'll be Detroit, where you have to go to a federal judge and say, we're going to reduce the benefits to our retirees. It won't be pretty. It'll be ugly. But going back to Prop 13, Prop 13 was approved in 1978. It predates 1999, and it predates 2004 when Arnold Schwarzenegger said, we'll give the property taxes to the counties and cities, and we'll take the sales tax, and it's called the triple flip. And as he's trying to deal with that recession in the mid 2000s, the liquidity crisis, the Big Short, et cetera. And so I don't know if we sit here and put Prop 13 in the equation as a problem. It has certainly, for counties, been a steady revenue stream, whereas personal income tax revenues for the state represent 2/3 of the revenue for the budget, and 1/2 of that 2/3, 1/3 of our revenues are generated by 1% of the population.
Wow.
They create, it's our wealthy residents. We don't give them fruit baskets every year to thank them for the amount of money they're paying. They have taxable income well in excess of $1 million. But if they stop selling stocks and enjoying capital gains, then the state will feel it rather quickly. So we don't have like Prop 13. We got this revenue stream that just keeps going. Personal income tax does this. And that's why we have a rainy day fund, but is it adequate? I mean, if LA Unified School District cried uncle because they just had to put $15 billion of unfunded retiree medical on their balance sheet because the Government Accounting Standards Board requires it. You know, if they come to the state for a loan, our rainy day fund is gone with just one school district. Granted, it's like the largest in the state, but we got some serious fiscal concerns.
You hit on a number of really important points there. One, you highlighted the idea of the fragility of relying on such a small fraction of the population. New Jersey just saw this with a single individual, David Tepper, moving
to Florida,
moving to Florida, which represented, I believe, almost 3% of the revenue.
Had to have a special session hearing to talk about it.
I mean, that's extraordinary when you think about it. That type of risk is very clear. And with the mobility, particularly of the technology billionaires out of Silicon Valley, that I would agree is a fragile system to rely on. The second thing that you brought up is this idea of the school districts and the need to invest in the next generation of Californians, right? And on my way here to Sacramento, I passed, as I come into Sacramento, I passed one of the numerous homeless camps, Hoovervilles, I think they call them. That's not true, but that's certainly what they appear to represent. We don't have the resources to invest that because we're so busy paying for these past promises. Is there anything that we can do to change that?
Well, we certainly have to figure out something and soon because we're crowding out other services. So I tried a bill just to show you how fun this is. It said, look, why don't we limit the amount of the annual COLAs to retirees until the fund is at least 80% funded. That way everybody shares, employees, employers, retirees, and that was killed. The number of union representatives that lined up against my bill was amazing. But the real answer is we've got to start going to a defined contribution plan going forward. Now, we have a model. Jerry Brown and Janet Napolitano sat down, and for the UC system, any new hire has the opportunity to select defined benefit or defined contribution, which is your 401k traditional plan. 37% of new hires have adopted the 401k plan. Why? Well, it's portable. They can take it with them. Two, they don't want to pay the high amount of contributions into the defined benefit plan because they're young and they want to pay for a house, they want to pay for childcare. They don't want a massive pension at a young age. So we have an opportunity to make some changes, but defined contribution, those two words are anathema to public employee union leadership. You just can't even whisper those words and they're going to go apoplectic. But that's what's got to be done. But watch every budget cycle, the Democrats are trying to kill the UC defined contribution plan, but that's where we've got to go.
Yeah, it's going to be interesting because a lot of the work that I do is actually on the vulnerability of the defined contribution plans. They're very much subject to mark-to-market risk. Effectively, you think you have a certain amount that is set aside, but you are increasingly reliant on your ability to sell at those prices. And with the sort of demographic bubble that we have in the United States, and California is actually even more extreme in some ways on this dynamic, you're looking at a situation in which that's not entirely clear that can happen, particularly under the current technology. But I agree with you that the fixed liability structure of a defined benefit plan becomes extraordinarily difficult. It's also amazing, though, to think that people would turn down that opportunity, given the underlying value of that sort of guarantee coming from a near inviolable state, right? It's extraordinary to me that people would refuse that for the portability dynamic.
And you don't have the risk. Like you just said, your 401k could languish, right? Stock markets doesn't do anything, you're kind of stuck, right? You might as well keep it in a money market fund, which isn't doing anything either. But at least your principal's intact. But with a defined benefit plan, you're putting all the risk on the taxpayers.
Yep.
And so, what is that? I mean, Peter Drucker said over 50 years ago, a defined benefit plan wouldn't work unless the employer could be guaranteed that it would continue in perpetuity. Mm-hmm. And the government's about the only thing that does that, right? Until it doesn't, until it hits the wall. We're watching Illinois, we're watching Puerto Rico, we're watching New Jersey, Connecticut, Massachusetts, just states that are just ready to get real close to the implosion factor. Illinois, just like California, is enjoying a mass migration out. People just don't want to put up with it. So Chicago is having its issues. So, it's going to be real interesting to see how it all plays out and who's going to be responsible. If you own a home in your city implodes, are they going to send you a note and say, hey, guess what? You own this percentage share and your family should contribute $10,000 to help us get to zero in our funding.
And it's very easy for us to view that type of notice and say, there's no way I'm going to pay, right? But at the same time, those states and counties have the ability to attach it to you in the form of a property tax, right? A special charge, a lien, that you can't get rid of unless you're willing to forfeit your property.
Right.
So we're looking at extraordinary power at the state government. Now, you and I were talking about a couple of statistics beforehand. State of California has approximately 45 million people, slightly more than that, I think.
I use the number of 40 million.
40 million, okay. So the California state senators, your district, you represent in excess of 1 million people, correct?
Very approximately 1 million, yeah.
Now, I mean, that's actually more than a congressional representative on a proportionate basis. And so as an individual representative, you have an incredibly diverse group of individuals that you represent. You highlighted an area that is of mutual concern, mental health, right? Contributes significantly to the homeless challenges that we face here in California. You sponsored, or if I understand correctly, there was an attempt to build a mental health facility in Orange County that you've spoken about. Can you share what you see as a model for how we can get some of that stuff done, how we can actually start to fix it?
Orange County is blessed with some wonderfully successful people, and traditionally very bright, smart people will have a child that has schizophrenia or is bipolar or has depression. It's sort of the family secret in Orange County. So we've been working on this dynamic from the ground up, sort of gotten organic. There are a lot of people that are making substantial contributions to form a nonprofit called Be Well OC or Mind OC. And it has already been able to work on building a housing trust, which we did legislation on 2 years ago. We have been able to find a facility in the city of Orange on Anita Drive where we can build a $65,000 office complex.
Square foot.
What did I say?
You said $1.
Oh, 65,000 square feet.
$65,000 anywhere.
65,000 square feet. Thank you, Mike. And so that will help those with mental illness and get them hopefully through an assisted outpatient treatment program to get the right medication, right dosage, and help them mainstream again. And so it's sort of an operation that's hoping to look for 2 other locations. Then we would at least have opportunities for people to kind of get back to normal. Mental illness is going to be with you for the rest of your life. It's just the way it is. Schizophrenia there's no cure, but you can compensate. We have a law professor at USC that has schizophrenia, but she medicates and she understands that she's got to stay on that medication to function properly. The minute she starts reducing or eliminating her dosage, she has psychotic episodes, right? So you just got to go with the program and then find your niche in life, and we can help people. But we don't. We let them just walk around and have their psychotic episodes on the street and scare housewives that are trying to buy groceries at the grocery store. They don't even want to go anymore because of what they're encountering. So we tried to expand the definition of gravely disabled, just had it killed last month, SB 640, which would have allowed for more of an involuntary hold. So we can keep you more than what a 5150 would do by keeping you for 72 hours. We could do maybe a little longer. So we can find that right medication to help you stabilize. And then you have to learn to stay on it. And if you don't stay on it, we got to, then you're going to go back out on the streets. So we got to figure out how to deal with that component. But we're trying as a legislator to try to change things. I could go into a lot more depth.
No, of course.
1967 with the Lanterman-Petrie Short Act. But
those sorts of things are exactly the challenge that we face, right? Because on one hand, you have, individual rights that you're trying to protect.
Right.
And mental illness is certainly something that I'm very familiar with. The challenges that are created when you don't have the ability to effectively put, medical power of attorney in the hands of a responsible individual and force somebody to seek treatment.
Right.
It can also be abused quite badly. I don't want to end on that note, and I also don't want to end on this next one, but I do want to make sure we get it in. We talked about this idea of transparency, right? And so trying to understand how much things cost. You introduced a bill that made it through both houses in the state in the last year that was simply designed to introduce XBRL, the language, so that the information, the financial information in California's budgets was easily and transparently available in a digital form. What happened?
Well, it was vetoed by Governor Newsom. And tragically, it takes me weeks, months to get 482 cities' comprehensive annual financial reports. But if they were all required to enter that information for, let's say, the treasurer's office or the controller's office, what I do is I take their unrestricted net position, divide it by their population to kind of get a metric of, what's your temperature? Where are you? You're positive, negative, and where do you fit in the range? It takes us weeks, months, but if I had XBRL, I could do it in seconds.
One other quick question on a related topic, right? The CalPERS, which we've talked a lot about, has a new CIO, or a relatively new CIO, and he's come under fire for investments in China. I would personally castigate him for his decision to eliminate all active managers. So they've gone with a strictly passive approach. As a legislator, as someone elected to represent Californians, what can you do in relation to that type of dynamic?
Not much. You have a retirement board. It oversees the investment policy statement. And there are studies that show that passive investing may be better than active. Active is interesting because you're paying someone a lot of money and you're going, why am I just not paying them for the alpha instead of, if they're just meeting the benchmarks, what am I getting? And so you can see this trend going where a lot of people are in the investment arena are saying, let's just go passive. And then you get into fees, the whole gambit. So a passive account is a lot cheaper than hiring a good group of smart people that are investing your money. And at the end of the day, who knows who's right? But there's at least some empirical data that says maybe you ought to go this way. But I mean, even CalPERS, it's run by human beings, right?
Yeah.
They thought that Hillary Clinton was going to win, so they lowered their investment allocation in the equity markets, and they lost $1 billion within a few months after President Trump was elected. So, these opportunity costs, they get real expensive.
Well, I think that's one of the fun things, right? I mean, just like you didn't know for certain that Bob Citron was going to blow up, but you certainly had concerns about the way it was exposed. I would suggest I have concerns. I don't know that it's going to blow up, but I have a lot of concerns that I believe are well placed in terms of passive investing. This has been such an honor to sit down with you, Senator Moorlach, and it is really, really my pleasure to have you here. I'd love to be able to come back at some point in the future and sit down and talk with you again.
That'd be fun.
Excellent.
Please.
Thank you very much.
Thank you.